Victor Chiazo is the head of research at FSL Securities and is joining us for some of this conversation, taking us through what's the thinking in the engine room at FSL Securities. Victor, it's good to see you in the new year. Thanks for coming through on the show.
Thank you for having me, Wilson.
It's good to have you. Thank you very much. What's your overall reading of the MPC, leaving all the parameters unchanged? But what do you think is in that? What's the message of Tuesday's MPC decisions and considerations for the marketplace?
Yeah, I think leaving all policy parameters unchanged, the last MPC meeting, it just signals to the fact that this present MPC team and the present government are actually focused on allowing the economy recover on its own, instead of injecting it with a stimulus that might actually push growth in the immediate term. So I think with what has happened in the market, which is currently shown from the MPC, I don't really see any significant change in terms of happenings in the fixed income market and the equities market. So I think we might see some form of normalcy. There might not be any upside or downside. We might just see a bit of stability in both spaces. But the risk to this is that the equities market in the medium term and long term might actually suffer, because activities will still be targeted more in the fixed income space. And we might continue to see GDP growth be in between 1.5% and 2% region, which we feel for us, we feel is quite low, given the fact that the Nigerian population still grows about 2.6 to 3% yearly.
Victor, the MPC, the central bank, has held MPR unchanged for 14 quarters. Last Tuesday, or this week Tuesday, was the 15th time. So this is not news to the equities market, right, isn't it? So you folks should have gotten used to it by now. So how do you use these MPR unchanged or status quo to rev up the market? What do you do with it?
It's going to be pretty hard to use what the CBN is actually doing to boost confidence in the market and activities. Because the truth is, given the fact that the real economy, the real sector is still being squeezed, little or no activities is happening in that space, the stocks or the companies listed on the Nigerian Stock Exchange, they're not shielded from what happens from the broader economy. So what happens in the broader economy affects their performance in terms of both top and bottom line. So once that happens, we don't see that significant increase in terms of revenue, in terms of profits. Definitely, investors will not be so much in need to actually direct their funds to that space, because if I'm investing in a stock which has little or no possibility of capital appreciation, I'm only investing for the dividend, and there's a possibility of the profits of this company not growing, I'm probably going to be stuck with the dividend between 5 and 10%, which is not guaranteed. But look at the other space. We're looking at the fixed income space, looking at the money market, looking at the treasury bills. We have a fixed return of about 15 to 17%. Without sweat, risk-free. For me, a sane investor would not be looking at the equities market. Okay. Yes, for some investors, they might want to diversify, but the truth is that so far the real sector of the economy continues to be squeezed. Okay. It will affect the capital market. Yes. And so far, MPR is still high at 14. The capital market, the equities market, are going to suffer, yes.
You spoke about what investors will be looking at for, since the headline interest rate is not changing. So then we're going to look at dividend, you look at capital appreciation. So what's the strategy, therefore, for stock picking? Do you think the broader macroeconomic environment will anyway help the balance sheet of quoted companies to help investors at least pick some of these stocks?
Yeah, I think in terms of cherry picking in the equities market, the truth is that you need to do your due diligence. But in a medium to long term play, I think what will actually drive investor sentiment towards the capital market, towards the equity market, is strictly, for me, the outcome of this election. if you look at the body language of both major contenders, the APC and the PDP, it's clear that one is for the expansionary side and one is on the contractionary side. So depending on who comes out tops and becomes commander-in-chief, I think we might begin to see some similar activities in the equities market. For the PDP, he has said he's willing to risk inflation for GDP growth. I think from that statement, I think that should tell investors where their money should be going, especially in the equities market, if he comes out to be the next commander-in-chief. But if APC comes back and the APC government is back, I think we might just need to cherry-pick in terms of position in the equities market. But for me, I think we need to look at the blue-chip companies, stay within the blue-chip company, stay within companies that have actually been able to weather the storm in terms of all the headwinds that have been pushed against them. They've been able to post their decent numbers, and they've been able to show a high level of corporate governance, because that is key. If you see what's been happening around companies listed in the Nigerian Stock Exchange, you find out that those companies that have little or no corporate governance are continue to suffer. So I think corporate governance is key, dividend return is key, and performance over the year is key for any investor looking at investing in the equities market.
Okay, so what's your outlook on the new earnings season?
Yeah, for the earnings season, I don't see that much change. I expect I don't expect any surprises. I expect earnings to be in line with what we've seen in Q3. We've seen some of the banks posting decent numbers. I expect most of the tier 1 banks, likes of GT Bank, Zenith Bank, to remain strong. I expect them to post decent numbers as well, reward investors with decent dividends. UBA as well. For Access Bank, I'll be a bit, I would like to do a little bit of research on that and do my due diligence, because given their last analyst call about the merger with Diamond Bank, you might want to be a bit skeptical, because they are saying they're not going to be raising the 75 billion. They're looking to consolidate this transaction, and they're saying they're expecting about 150 billion over the course of years in terms of write back, and they'll be able to fund these transactions from their earnings. For me, that signals the fact that there might be a possibility that this bank might not be dishing out dividends. They might actually want to keep these earnings to be able to wrap up this transaction, and that might not go well, especially for shareholders that are looking for returns. But in the long term, I think you might be looking at Access Bank. But in the short term play, GT, Zenith, Fidelity in the tier 2 space are also good buys. In the manufacturing, we're looking at Dangote Cement, still posting decent number. Lafarge, for now, is still trying to weather the storm. How they go about it after their rights issue, I think analysts' eyes, most of the investors will continue to watch that space. For other sectors, I think the best thing investors need to do now is actually look at their numbers. Any company that sees policies, especially these current government's policies that will favor, I think investors should begin to position ahead of whatever policies that might come and how it might affect their earnings.
Victor, what exactly does the market want from the political arena? In other words, what type of I'm trying to find policies or what you call buzzwords do you think will generate investors' interest? Is it plans by some political candidates to privatize some certain percentage of an MPC? Is it a further sale of national assets, concessioning of seaports and facilities and what have you, sale of government assets? What exactly is the message that the market wants from these elections? Who do you think the market would want in terms of being a jolly good fellow?
I think for now the market would actually be happy to see a commander-in-chief that actually is in favor of an expansionary policy, because it seems as if that the current government, they're more reserved and they're trying to be careful so that they don't make a mistake in terms of making a decision or putting out a policy out there that will actually stifle growth, and we see ourselves back in the time where we had a recession. And I think that period of where the country was in a recession, I think it hit this current government below the belt. So I think they're trying to be careful. But the truth is, the market actually needs more of a government that is more into the expansionary side of things, because the truth is the market has been stifled from a lot of things, from rising inflation to rising interest rates to a lot of instability in the FX market. So I think right now we need someone that can say, okay, we are going to expand the economy. The current government, we heard the current minister saying that they're going to increase tax. Yes, increasing tax is a good one in terms of increasing government revenue, but that still shows you that we're still going to tighten, because once you increase tax, the little amount available for the individual to spend it becomes lesser, meaning that you have less money to spend and you continue to stifle the economy. We're having possibility of a rise in tax rate. We're having high interest rates, which continues to stifle the real sector of the economy. So I think all these things are things that the markets continue to react to. So we need a government that will say, come, it is time to push this economy forward. It's time to drop interest rates and allow the real sector of this economy get access to funds and actually push the general market forward. And a few other policies that I think investors will be wanting to hear right now.
Okay. Victor, thank you very much. Of course, it's all about, you don't want additional holes in your belt to tighten it further, just to take it, relax it a little bit.